Today, tech in correction territory. Hello again, it's Martin North from Digital Finance Analytics, where I posts covering finance and property news with a distinctively Australian flavour. Well, strong US and European corporate results could not stop a slide on Wall Street, where the NASDAQ entered a correction as rising crude prices kept inflation concerns alive, even as bond yields eased a bit after touching fresh multi-year highs. The NASDAQ closed down more than 10% from its November 19 record, and that confirms a correction as investors continue to price in the Federal Reserve moving faster to hike interest rates. And those fears, of course, led to Tuesday's sell-off. Stock markets on both sides of the Atlantic initially rebounded, actually, with an index of Europe's 600 biggest stocks rising as much as 0.8%, as robust earnings from luxury majors Burberry and Richemont countered pressure from rising yields, but the gains faded as concerns about rising inflation and higher rates rattled the market as investors await the Fed's policy meeting next week for any change to the central bank's plan to tackle inflation. The market is still grappling with how do you adjust for higher rates and what are the companies that are impacted by higher rates, said John Mayer, Chief Investment Officer at Global X ETFs. The market was very excited that maybe the Goldman Sachs earning numbers on Tuesdays weren't so bad. Then reality sank in. The broad stocks Europe 600 index closed up 0.23%, but the MSCI's all-country world index fell 0.74% as Wall Street sold off late in the session. The Dow Jones Industrial Average fell 0.96% to 35,028. The S&P 500 slid 0.97% to 4,532. And the NASDAQ Composite dropped 1.15% to 14,340. That's correction territory, of course. US Treasury yields earlier hit fresh two-year highs, and Germany's 10-year yield broke into positive territory for the first time since May 2019, as investors bet policymakers would curb years of stimulus in order to fight rising asset prices. The rise above 0% for the Bund, the Eurozone's benchmark, does mark a turning point for regional debt, reflecting record high inflation that has been exacerbated by supply chain disruption. This inflationary episode is unusually challenging in that it is driven by both strong demand and shortages of supply, said Guy Foster, Chief Strategist at wealth manager Brewin Dolphin. Oil prices hit their highest since 2014 amid an outage on a pipeline from Iraq to Turkey and global political tensions that stoked fears of more persistent inflation and helped prop up the dollar, which hovered near one-week highs. The market is making interest rate adjustments throughout the major industrialized economies, said Mark Chandler, Chief Market Strategist at Bannockburn Global Forex. Those countries that seem to be ahead of the US in the queue of raising grades, Canada, the UK and Norway, have stronger currencies this year against the dollar. Other areas like the euro, Swiss franc are softer on the year. The dollar index, which tracks the greenback versus a basket of 6 currencies, fell 0.14% to 95.58. The euro was up 0.16% to 1.1343. And overnight in Asia, MSCI's broadest index of Asia-Pacific shares outside Japan fell 0.4% as tech stocks in particular suffered, as they had on Tuesday in Europe and on Wall Street. And Australia's main index shed 1% yesterday, while Japan's Nikkei hit a 3-month low, as worries over new curbs on businesses to halt a record surge in coronavirus cases curbed risk appetite. The 2-year US Treasury yield, which typically moves in step with interest rate expectations, rose to 1.051% later in the session after earlier trading lower, and the yield on the 10-year Treasury note fell 1.8 basis points to 1.854 after also trading lower. Oil prices rose for a 4th day after a fire on a pipeline from Iraq to Turkey briefly stopping flows, increasing concerns about an already tight short-term supply outlook. US crude futures rose 0.22% to $85.02 a barrel. Gold rose more than 1% as a retreat in the dollar and geopolitical tensions surrounding Ukraine burnished safe haven bullion's appeal. Gold futures settled at 1.56% to 1,840 an ounce. And the volatility index. The fear index was up 24.28% to 2385, and that's a new 1-month high. And Wall Street's 5 largest lenders generated a record $55 billion in revenue last year from putting together stock and bond offerings as well as advising corporations on mergers and acquisitions. That was up 40% from 2020, aided by the slew of takeovers and initial public offerings for special purpose acquisition companies. And bankers aren't done yet. Executives emphasized on conference calls with analysts that they expect even more deal making to get done this year. Goldman Sachs Group pointed to recent disruptions in corporate supply chains, saying that companies are being forced to consider more acquisitions to achieve greater scale, both from a backlog perspective and real-time activity, and just getting around with CEOs broadly. We think that there is a good tailwind for continued M&A activity, Goldman Chief Executive Officer David Solomon told analysts this week. The uncertainty in the environment, interestingly, is actually helping that tailwind because it's forcing people to look hard at ways they can strengthen their competitive position. The investment banking boom helped buoy revenue in a year when loan growth largely remained elusive, crippling net interest incomes across the finance industry. And many firms also contended with rising costs as the ongoing war for talent forced companies to dole out more in compensation. But perhaps it's no wonder that the finance sector is under pressure, because the question is, will those deals be done, and will they generate the revenue that they did last year? And elsewhere, Chinese regulators are considering lifting some restrictions on developers' access to cash from pre-sold properties tied up in escrow accounts, according to some insiders. A potential major step towards easing the industry's liquidity crunch. Regulators, including the housing minister and the banking watchdog, are still discussing details and may convey the instructions through window guidance to local governments later this month, according to people who should know what they're talking about. Authorities are contemplating a package of policies to prevent a deepening of the real estate crisis. Regulators are fine-tuning their long-running crackdown on the property sector after a credit crunch in China. Evergrande Group and other junk-related developers began spreading to higher-rated peers. A property-led slowdown in the economy has pushed policymakers into easing mode, with the central bank cutting interest rates this week and pledging to open its policy toolbox wider. Easier access to pre-sale funds would improve cash inflows for stressed developers, which are seeing many financing channels dry up. Yields on China's junk dollar debt surged past 20% this month, making offshore funding markets prohibitively expensive. And weaker firms are also struggling to sell debt to onshore investors. Equity financing is similarly tough. When Sunup China Holdings tapped stock investors last week, its shares sank a record 23% in Hong Kong. Some local authorities have already made moves to ease pre-sale restrictions. Yantai City in eastern Shandong province on Tuesday allowed the highest-rated developers to withdraw a bigger proportion of funds from supervised escrow accounts, according to a notice on the municipal government's website. Developers should first use the additional funds to pay migrant workers, it said. And in Shandong, the capital of the southwest province of Xinjiang, the local government said in November that developers will be able to use proceeds from pre-sales if they meet certain construction progress. But here again, of course, the question is, will this be enough to make a difference? The property sector continues to grind lower, and at the moment, I'm not sure whether there is enough momentum to turn it around. Because it's such a large part of the overall Chinese economy, this remains a big deal. So, whether you look at China, investment banking, or the tech sector, things continue to wobble along. And that is why I think the forward view would be that there will be more downward moves ahead rather than a significant bounce, at least in the short term. And if the Fed does come out next week with something that really signals significant rate rises ahead, then expect markets to go lower still. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.